Hello, hi, I'm Nick Burgess. I'm a quant analyst, and today I'm going to talk to you about American option trading and analysis. The idea is I'm going to take you through some slides, and we're going to discuss the trading of American options. And I'm also going to show you live trading screens as well on the IB Broker trading platform. So, without further ado, let's go. I'm going to share my screen and give me one moment. Here we go. And let's run that in full screen. So here we are, American option trading and analysis. And I've split this training session into four parts. Part one, which we've already discussed, was on American option trading. Part two, which is the current video, is on trading strategies, where we're going to look at directional income trading strategies for options. We look at range trading and spread trading strategies as well. And then in part three, which is the next video, we look at pricing and optional optimal exercise. And part four, we look at interactive brokers option pricing and how to replicate those prices in an Excel workbook. And the Excel workbook is the link to that is here for reference. Okay, so part two, trading strategies. Here we go. Now, option trading strategies, they can be directional, whereby we're trading the direction of the asset price and or the volatility level. They can be range trading strategies where we profit if the asset price remains within a range or not. And we can have spread trading strategies where we're bullish or bearish, but we also incorporate risk management where we cap our risk and our reward. Now, in terms of, I'd like to make you aware of some useful references and resources. So there's some websites here I'd like to sort of refer you to. So we have the Option Traders Toolkit, which I'll show you on the screen, which is this one. This one here. And I love this website because it's really useful because you can build, if you select build up the top, you can pick sort of different trading strategies and it tells you if they're novice, intermediate, advanced, or expert. And you'll get like a description of the strategy, such as Iron Butterfly. And if you click into it, you'll also get then a graph of the profit and loss in percent or in dollars, and you also can see a table of a what if kind of scenario. So what if stock prices go up or go down over what kind of tenor, and you can sort of see you can sort of see what your risk profile is going to be. So it gives you a lot of intuition about option option trading strategies in general, and tells you the when you're going to make money, when you're going to lose money. So it's really good for, again, a good overview of options trading strategies. Now, the other thing that's really useful, interactive brokers have a free trial and simulation account. It doesn't cost you anything. Maybe a little bit tricky to set up, but it's a very excellent sort of tool, which is available here. And then the other thing, which is much easier to set up, is the CME trading tools on Market Simulator. Less useful, but gives you really good intuition on how to trade sort of options markets, options and futures markets. So you can see that the links are here. Feel free to try these out. Now, in terms of option trading strategies, we can obviously we looked at previously how to trade a single call, single put. And we can sort of see all our option prices on an option chain, which we discussed in the last video. And if you want to sort of trade a trading strategy, such which we're about to sort of discuss in the next slide, this is just how you do it within IB Broker. So the way that works is you pull up your option chain for the underlying of your choice. In this case, we picked KGC, which is a gold mining corporation, and gold prices are currently in a very huge rally. Here we sort of decided, well, look, we want to sort of potentially trade as travel. And the way you do that is you turn on the strategy builder inside your option chain. This will then enable you to sort of select a strategy from the drop-down list here. We pick, there's many different choices down here: butterflies, straddles, triangles, risk reversal, boxes. Quite a lot of different strategies. You pick straddle for as an example, and then you'll have a little. If you hover then over the bid or ask of your call or put for your respective strike, you'll then sort of start seeing the different legs of your trading strategy being automatically selected for you. You pick on the initializing trade. In this case, I want to be longer straddle, so I pick an ask, so to go along the call at 25, and it'll automatically sort of select the put at the corresponding strike and populate the strategy builder. You see the two legs, and then you're able to sort of then under the choose to view the risk profile, see all your break even and your risk profile in general, and you can actually then sort of trade this strategy as a single trade, which potentially reduces your transaction costs relative to sort of instead of sort of booking the two trades individually and potentially having some risk that they don't execute at the same time and at different levels. You can choose to execute the trade as one um, in one go, in one fill, and we can also reduce your transaction costs. So that's all done through here. Let's have a look at that on the screen, on the live screen, what that would look like. So I pick KGC, you pull up the option train, which is under trading tools. This is a simulated account. It sort of defaults to the, you then pick your strike, it sort of defaults to the 0-day option. Is an option expiring today, which is so you pick the option that you want, the option maturity. I'm going to pick Jan 2026. So that's my expiry. Then you turn on the strategy builder, and you see the strategies window will show up in the bottom right. Quite a lot of different strategies you can pick. I'm going to pick straddle in this case. Then it asks you to pick a leg to apply the straddle to. Nothing happens until you sort of highlight a bid or ask price. You can do it on the put or the call. In this case, I'm going to say buy the call. If you want to go long the straddle, I buy the call. If I'm going to go short, I buy the sell the call. It's currently trading at 25, so I'll pick the at the money straddle. Then as soon as I click on this ask, it'll populate the two legs for you. You can choose to view the risk profile, and you can sort of see the break even and all the different scenarios. You can sort of change from position groups to instrument groups. So position groups are quite useful, so you see in dollar terms. And then if you want to execute, you can execute down here. Now, market's closed, so it's been closed for about an hour. And so this would normally be populated, but you can always, I think you might be able to change this to GTC, but I won't try doing that. Market's closed, but you can generally execute your trade down here as well and submit your order. Now, I'm not going to do that, so I'll close the screen, but I just want you to be aware of how to build an options trading strategy using IB Broker. So I'll close that screen. Okay, for now, and then we'll come back to our slides. And this I've given you a screenshot of what the option chain looks like and how to and the different buttons that you need to be pressing to build an option trading strategy. Now we're going to sort of discuss what the strategies themselves actually mean. So if we're looking at directional trading strategies, then I need you to be aware that in terms of option premiums, both call and put option premiums increase with volatility. So we go long calls or puts if we're bullish on volatility, and this is positive vega, and vice versa. We go short on calls and puts if you're bearish on volatility. And so if you look at the call and option payoffs that I've sort of plotted here on the right, you can sort of see this is the top is a call option, bottom is a put. And when the volatility is low, you'll see that the option premium will be very close to the payoff at maturity. And if you increase the volatility, so low volatility will be the red, high volatility will be the premium in green. And so you can sort of see that option premium is higher with higher vol, lower with lower vol. And that's exactly the same with put options as well. So lower vol is red, higher vol is green. And as volatility increases, yellow is mid vol, mid-range vol. You can sort of see as volatility is increasing, option premiums for both calls and puts increase. And so if you want to just trade volatility, you could just be long a call option, long a put option, and either would work. You know, you would benefit. You would generally speaking, you would benefit from option volatility increasing, all other things remaining equal. So you can trade just by being long a call or put, you can benefit from, if you're bullish on volatility, you can make money. If that's the eventuality. Now, call options, you're long. We go long calls if we're bullish on the price. So in this case, we're talking about price, not volatility. And call premiums increase if the spot price increases this positive delta. And so you can see in the call diagram, if the spot price sort of increases, then the option premium increases with it. And so you go long a call and you sell at a high level. Similarly, put options, you go long puts if you're bearish on the price, and put premiums decrease if the spot increases, which is negative delta. Now, so obviously, if you increase the spot, your premium is going to decrease. But we're trading this because we're bearish on the price. We think the price is going to decrease, and therefore the premiums are going to increase. So it's negative delta because delta measures move up movements in stock prices, and therefore this is negative delta. So the summary is we can trade, if we want to sort of trade volatility, we can be long a call or a put if we're bullish, and short calls puts if we're bearish. Now, call options, we're trading the direction of the price. Put options, we do price going up. We trade put options, we're betting that the price is going to go down. And we can kind of combine these two things. We can sort of say, well, okay, what if we want to trade volatility? We think volatility is going up, but we think the stock's definitely not going down. Then we buy a call, and then if we think, oh, well, the price is definitely not going up, then we could, and we want to trade volatility, then we could go long a put. So you can sort of combine these views, these directional views, by taking combinations of calls and puts. And sometimes you trade both, sometimes you trade one and not the other. Now, finally, we want to talk about risk reversals. So risk reversals are a synthetic stock position. And if you're bullish on the price, we would want to be synthetically long the stock. And you can achieve that by combining calls and put options. You go long an at-the-money call and short the at-the-money put. And that would sort of replicate. And so if you superimpose these two charts, these two payoffs, you short the long the call, short the put, you'll just have a long position. And similarly, if you're bearish, you can just take the reverse view. So you short the at-the-money call, long the at-the-money put, and that will, if you can combine the sort of, if you plot that payoff, you'll see that then you have you're replicating a longer short stock. Now, I think we can sort of see that very quickly in the pricing workbook. So if I pick on our trading strategies page, if I sort of pick here the risk reversal, I think I put one in. And I update, because I got some hidden things here, I'll unhide. I'm just using these call and puts. You can see I'm long a call, I'm short a put, and that's replicating a stock position. And then if I sort of reverse that position, you can sort of see, and I'm short a call, long the put, then you can see I'm replicating a short stock position. So risk reversal, natural position is being long, but you can do short to take a short stock position. So it's a nice tool for replicating those trading strategies. I'll put it back to what it was before. I think it was a butterfly. Okay, so option premiums. Just to quickly summarize, we go long. If you go long an option, you're trading. You're bullish on vol. Short an option, you're bearish on vol. And then if you want to trade the price direction, you go long and you're bullish. You go along a call, and if you want to, and if you think the price is going down and the vol's going, you can be long. You can be long a put. And then risk reversals are just synthetic stock positions, which we just discussed. Now, one of my favorite trading strategies when it comes to sort of options trading is very safe income generation strategies are the cash covered puts and the covered calls. Now, cash covered puts. We sell put, basically what we do here, we sell put options for income. They're generally out of the money puts with low, they typically have very low deltas, so the probability of exercise is pretty low. And the one thing to note is that the higher volatility generates higher premiums. So if you have moments, if you want to sort of sell put options for income, and you have moments where you believe the volatility is temporarily high, it's a great time to sell to generate higher premium. Now, with these income generation strategies here, cash covered puts, cash and the covered calls, we generally, our view on the underlying asset is that we're neutral on the price or mildly bullish. And what that means is we think the stock's trade is range bound and maybe it's got some upside, but we don't think it's going to fall in price. Now, but should it fall in price, and if we are assigned the options exercised and we're assigned, and we sold a put, so that means they're selling to us, we have to buy, then we buy the underlying stock at a discount, and if you're neutral to bullish on the underlying, you're actually pretty fired up to get you to be paid to buy stock at a discount, and what's often quite a significant discount. Now, covered calls, you own the stock already. So having bought the stock, you sell call options for additional income, and you earn a premium on the stock that you already own. And I think that's why we sort of say mildly bullish. So we sort of sell out of the money call options, and if the price sort of increases to that level, which can be to our target level where we want to profit take, we're going to get paid to take profits. Again, higher volatility generates higher premiums, which means we look for moments where we think that the volatility is momentarily high, to generate sort of additional income where possible. We said we're neutral to mildly bullish. We think we're range trading, the stock's range trading or mildly bullish, but not sort of wildly bullish. And we sacrifice some upside potential and sell a stock for a profit if we're assigned. But importantly, we pick the strike here such that it's typically at our target level anyway, and so you're not really giving a lot of upside potential other than that, you were going to take profits there anyway. Now, when you combine the two strategies together, that's called a wheel strategy. And what you can do is you can enter your position. You can enter a position by selling puts, and then once you're in a position, if you've been assigned, you can then sell covered calls to sell the stock at your target level and get paid. And so you get paid to enter your position at a discount, and you get paid to exit your position at your target level. So this is a very fantastic sort of trading strategy, and it's generally fairly sort of a straightforward one to sort of do. Now, I've got an illustration of what I'm talking about here, just to sort of really help sort of solidify what we're talking about here. So on this chart, I'm looking again at KGC, which is the Kinross Gold Corporation gold mining stock. Gold's been going through a significant rally this year, sort of touched sort of $3,800 per troy ounce sort of earlier this week, and it sort of started to sort of the test now the $3,900 per ounce level. So it's really significant sort of rapid growth. It was only like a week or two ago. It was trading at it just broke through the $3,700. So it's had very rapid growth. And Kinross Gold also itself, as a mining corporation, is doing very well, had very positive analyst reviews, upgrades recently to the $27 level. So we're very bullish on this stock, and we're very bullish on the on gold prices as well. So that's my sort of personal view, and so I am in the neutral to mildly bullish, or maybe very bullish potentially. And this is a trading strategy that I've actually sort of exercised myself sort of several times this year and sort of made good money on, so good income on. And the idea is that so your gold has been range trading, it was range trading for some time, very positive outlook, and so you sell puts at this lower level here, and you sell puts to enter. So the if you don't hold if the buyer of the put exercises his puts, he sells to you, you buy, so you buy to enter at a low level, so you get paid to enter your position at a discount, which is fantastic. If you don't enter your position sort of immediately, you could just keep issuing a series of cash covered puts till they exercise. You may sort of get multiple non-exercise. So there might be no exercise sort of several times, and the options expire sort of worthless. So you just issue another one, and eventually, if you do get assigned, you then sort of sell a covered call to exit your position at your target level, which is above. And you may again have to sort of sell several cover calls before you exit your position. And you get paid to buy it at a discount, and you get paid to exit your position at your target level, which is in addition to any profits you made and trading the range. So it's a fantastic strategy. And then this works well in range traded environments, which you can sort of see here, but it also works well when you have positive momentum. So if the stock's sort of increasing, you can sort of purchase, you repeat the strategy, sell puts, sell calls. So you sell puts at and you try to pick up sort of retracements in the market, basically. So you think, okay, you're reaching a top, you sell and retrace, but you still think it's got further to go. Then you could sort of continue the strategy. Um, and this stock had sort of very continuous sort of good news coming out, good earnings reports, gold levels sort of increasing. So the macroeconomic outlook for gold as well is very exceptionally positive. And we're in a bit of a gold rush. So there's so I'm definitely not bearish on this particular asset. I do think we probably have some kind of significant retrace at some point. So maybe the range, the spread between so the range between sort of selling and buying. So buy to enter, we might lower that range significantly. So we're much further out of the money, perhaps, as a precaution, because I think we're reaching the top. But this is a great income sort of generation strategy, and one I've sort of used sort of several times myself. So it's a pretty straightforward strategy. Now we have also have range trading strategies where we can sort of we looked at sort of a straddle earlier on. So basically a straddle, we're looking to profit from big stock moves and or increases in volatility. So this is the payoff of a straddle here. So spot price, if we assume a spot price of 100, stock prices go up in a big way, we make money. If stock prices fall in a big way, we make money. If they stay sort of range bound or in the middle, then we lose. Then we don't make money. Um, we also make money if volatility increases because the premium's increasing. So if you look at these diagrams, so we trade a straddle is a long call, long put. So we will make money if vol goes from low to high. So if volatility increases, we're going to make money. So we trade these when we anticipate a sharp move, and that might be from earnings announcements or events. And straddle is you buy the at-the-money call and buy the at-the-money put. You can obviously be short the straddle when you do the reverse. And the strangle, which is very, very similar, almost identical to the straddle, except that using at-the-money calls, we use at-the-money calls and puts because they're cheaper. Now, another strategy we have here is called the butterfly. The idea here is we have cap profits when there's no big move in stock, and when there's decreasing vol, and that's kind of the opposite of the straddle. It's also cheaper because we've capped our profits. We expect the price to sort of stay near the middle, to hover around the spot levels. If volatility decreases, that's also very helpful. And those positions are formed by being long an in the money call, short two at the money calls, and a long one out of the money call. And we can also do this with puts. There's also something similar called an iron butterfly, which I'll leave you to look up, which is sort of very similar to this. Now we also have an iron condor, which is a butterfly with a wider profit zone, and we short call spread and shorter put spread, and spreads are what we'll talk about in the next sort of slide. Just let you be aware there's an iron condor as well, which is just where you have a wider profit region or profit zone. Now, spread trading strategies, I've got some payoff images for you. So a vertical spread would be a bull or a bear spread. It's a directional bet with capped risk and reward, and we're moderately bullish or bearish. So this is a bull call spread. So you're long a call, short a call, and the short call that's the short call at the higher strike is then sort of capping your profit potential, but it's also making the trade cheaper. And then that's where you think the price is going up, and then the bear put spread is you long a longer put, and then you sell a lower strike put, and that will make the bear put spread. And they're called, I wanted to sort of mention, they're called vertical spreads because of how they look on the option chain. So if we pull up the option chain here, so you can just see what I mean, option chain, and instead of seeing in tab view, I'll look at it in list view. When not that actually it doesn't make much difference, but if you so if you're looking at when you're trading sort of strikes at different levels, it's the strikes are sort of vertical, they're listed one on top of the other, and so that's called a vertical spread because of how it looks on the screen. And then when we're in the and when we're changing time, and you're on the tab view, this is kind of like horizontal. So the names for these things have just come from how. So if you're in the sort of the tabbed view by default, when you're trading sort of strikes across different times, those are horizontal. And when you're trading strikes within the same time, you're vertical, and that's where those names come from. It's just the layout of your option chain on a lot of the brokers that we interact with. So that's where these names, vertical and horizontal, come from. It's just how they look on when you're booking your trades on your broker platforms. So that's just an introduction. That's just where those names come from. So the vertical spread, you're betting on you're moderately bullish or bearish. You think its price is going to go up. You think it's not, but you don't think they're going to go up a lot. So you don't mind selling in this case, selling the call and capping your profits just because you just don't think prices are going to reach that far. So maybe you're sort of range trading, and maybe you think it's going to go up slightly, but not so much. Um, and likewise with the put, maybe you think price is going to fall a little bit, but not too much. And so you're quite happy to sort of make the trade cheaper and sort of cap some of your profit just because you just don't think prices are going to going to decay or drop off that much. So the bull call spread, you buy a low call strike, you sell a high strike call, and then for the put spread, you buy a high strike put and sell the low strike put, which is what we're seeing here on these diagrams. Now, we also have horizontal spreads, which we alluded to already, and those are calendar spreads. That's the idea that it exploits time decay or volatility differences. We're neutral to slightly directional, and we're betting on decay. So we trade a long-dated option and a shorter-dated option at the same strike. And the idea is you're long the longer dated, you're short the shorter dated. If longer dated options go up, you benefit relative to the shorter ones, then you benefit. So you're betting on vol sort of increasing, and vice versa, maybe vol decreasing, and you sort of betting. So it's kind of like a steepener type play where you betting on the slope of vol almost. So that's the calendar spread, and then we got a very interesting one, which is the box trade. The idea is it's a synthetic loan via arbitrage if executed and priced correctly. Works very well with European options. And we exploit mispricing in option markets as well, potentially. And the idea is you go long a bull spread and you go long a bear spread. And if you look, and if you superimpose these two payoff diagrams, you sort of see sort of below 100, as well, say 94-ish. On the lower end, you can see we make 10. On the upper end, we make 10, which is just the difference between the strikes that I've chosen. And in the middle, if you overlap these slopey areas, they also add up to 10. And so everywhere you earn 10. And the idea is you pay for this option strategy, and at expiry, in all situations, you receive 10, the payoff of 10, and the premium that you would pay for this position is less than 10. So in effect, you have a synthetic loan. You pay a premium up front, which is less than 10. At maturity of the options, you receive 10 in all situations. It's risk-free, and in effect, it's a synthetic loan. This is a box trade. Now, that's all the trading strategies I wanted to touch on for now. If you want more information, please, we have lots of resources available to us. You can subscribe to my newsletter, which has a really great archive as well for things such as American options trading. And you can subscribe to my Quant YouTube channel for the above videos. And we also have an algo trading quant store, and you can follow me on LinkedIn. So thank you very much for your time. Please do subscribe to my YouTube channel, and I'll see you shortly in the next part. Thank you.